Hello viewer, and welcome back to Advanced Auditing and Assurance class. In this lesson, we will focus on answering a question on prospective financial information. Now, the question I have reads that ABC Limited is applying for a bank loan to support its expansion plan, and the loan would amount to USD 10 million, repayable in equal installments over 3 years between 2020, 2021, and 2022. In support of this application, the company has prepared a cash flow forecast for the next 3 years and has asked you to provide a report on the bank to the bank on the cash flow forecast. Now, this is the cash flow forecast. We can see there's an actual for 2019, budget for 2020, 2021, and 2022. Now, the sales actual for 2019 are 7 million, and the budget for 2020 is 7.5 million, 2021 8.5 million, and 2022 9 million. There's cost of sales at 2.5, that's actual for 2019, 2.7 for 2020, 3 million for 2021, and 3.5 million for 2022. Receipts from customers are 6.9 million, that's the actual for 2019, 7.4 million in 2020, 8.4 million 2021, and 9.4 million in 2022. The payments to suppliers are 2.5 million in 2019, actual, and the budget is 2.6 for 2020, 2.7 million for 2021, and 3 million in 2022. Other outflows include salaries and wages, which are 1 million, the actual for 2019, 1,050,000 for 2020, 1,100,000 in 2021, and also 1,100,000 in 2022. Administrative charges are 800,000, then 850,000, 900,000, 920,000 in 2022. The depreciation charge is 100,000 for the first 2 years, 2019 and 2020. Then it turns to 110,000 in 2021 and 120,000 in 2022. The capital expenditure is only 200,000 in the year 2020, and there is no other capital expenditure for any other period. Now, taxation is 520,000 as the actual in 2019, and we have 560,000 in 2020, and then 678,000 in 2021, and 772,000 in 2022. Now, the net cash flows are 1,980,000 actual in 2019, 2,040,000 in 2020, and we have 2,912 in 2021, and 3,488 in 2022. The balance brought forward of cash is 500,000, that's the actual, and we have 2,480,000 in 2020, 4,520,000 2021, 7,432,000 in 2022. Then we have cash flow balance. The cash balance as per brought forward now for 2020, carried forward for 2019 is 2,480,000, 4,520,000, 7,432,000, and finally 10,920,000 for 2022. Now, the question asks, you are required to describe the work you would perform in the examination of the prospective financial information. So you are required to describe the work you would perform in the examination of the prospective financial information. Now, in this question, you will have to really delve into a number of issues, including those that we have discussed in the bit of prospective financial information, acceptance, and the others. But also you now delve into the information that has been provided in form of the forecast. And the first thing you do is, so we look at the PFI procedures. Now, the procedures you'll carry out on these prospective financial information will include, number one, agreeing. So you agree the opening balances to the cash book. Agree the opening balance to the cash book balance. That is, we are told that the opening balance is 500,000, as you can see. So we need to, and this is actual, that means the financials have been audited. So we have to check if this 500,000 agrees with the records of the entity in the books. That's the first point. Number two, we have to agree actual 2019 figures. Agree actual 2019 figures or amounts to the historical financial information or financial statements, stock statements. Now, in this case, we'll have to agree, for example, the sales to the statement of profit or loss and other comprehensive income is the amount that we are given of 7 million in the actual sales as per the profit and loss account for the year 2019. We have to also agree the receipts. We have receipts from customers, and we also have payments to suppliers, and we also have the issue to deal with the taxation that you are paying and taxation paid. We agree this to the statement of cash flows. You see the amounts we have here that are talking about receipts from customers and payment to suppliers in the year 2019. We have to agree them to the statement of cash flows, because the statement of cash flows, if prepared on using the direct method, it will have to have all this. So you have to agree them to the statement of cash flows. The third procedure we'll carry out on this prospective financial information is obtain an understanding. We need to obtain an understanding of the cause for the impressive increase in sales. We can see sales have risen from 7 million in 2019 to 7.5 million in 2020, 8.5 million in 2021, and finally 9 million in 2022. This is an increment of 7% in the first year. We have 13% in the second year, and we have 6% in the next year. So we want to understand what must have made the improvement in sales to take place at this rate, or is it realistic? And this can be done by obtaining and examining sales budgets. So we can obtain and examine sales budgets, and we can also obtain industry averages and compare the industry averages to the company's performance and check if they are in line or there are variances, and inquire of the variances and discuss them with the management. The fourth procedure we need to carry out is compute relevant ratios from the information that you are given. We want to compute relevant ratios based on 2019 financial results or the figures, and we use them for analytical purposes. So for analytical procedures. Now we can do this, friends, if you look at our cash flow forecast, which we have here. We can see that in the year 2019, sales were 7 million and the cost of sales was 2.5 million. So the first ratio we want to compute is the GP percentage, the gross profit margin percentage. And this gross profit margin percentage will start with the gross profit, which is 7 million minus 2.5. So it is 4.5 million. Let's hold the zeros. and the gross profit margin is the gross profit over the sales themselves. So 7 million. We are holding the zeros again. So in this case, we will obtain 64% as the gross profit margin. If we go to the next year, which is 2020, we'll find that the gross profit is 7.5 minus 2.7, which is 4.8 million, and the sales are 7.5 million. So this gives us a percentage of 64% again. If we go to the next year, which is 2022, so this is 2020, this is 2020, this is 2019. So you go to 2021, the gross profit is 8.5 minus 3 million, and this one gives us 5.5. So 5.5 we divide by the sales, which are 8.5, and this gives us 64.7% in 2021. Now in 2022 we have the next one, which is 9 million minus 3.5, which again gives us 5.5 as the gross profit, and our sales are at 9 million. So our gross profit margin is 61%. So we need now here, once we have computed this, we need to inquire why the change. Here we inquire why the change, because we can see it was 64%, then 64%, 64.7, and in 2021 it goes down to 61%. We need to inquire why the change and discuss with the management to obtain an understanding as to why the gross profit margin is changing, and we also obtain the industry averages and compare them with the results that the company has, and also discuss with management and ask them why there is a variance maybe between the industry averages and the company's performance. The next industry, or the next ratio that we need to compute in this case, is the ratio that is dealing with salaries and wages. So we now look at the second ratio here, because we are discussing about ratios, salaries and wages ratio over the sales. So in our case, the salaries and wages for the year 2019 is 1 million, while the sales were 7 million. So this gives us 14%. That means that the salaries and wages are 14% of the sales. Now this is for 2019. In 2020, we have our salaries and wages as 1,050,000, and our sales are 7.5. So we have 1,050,000, and our sales are 7.5 million. And this one gives us 13% in 2020. And then we go to the next year, which is 2021. We have our salaries and wages as 1.1 million. That is 1.1 million over the sales, which are 8.5 million. And this gives us 12%. And we now need to ask why this is for 2021. And also for 2022, we do the same thing. Now you can see this was 14%, 13%, 12%. This means improvement in efficiency. So there's efficiency improvement. Now we need to discuss with the management and inquire why the improvement in efficiency, albeit in small percentages like 1%, but you'd want to understand why was the improvement in efficiency achieved. What must have they done to improve the efficiency in percentages? Percentages in efficiency. Next, we need to look at the issue to deal with the administrative expenses that we have here. So admin expenses, and these admin expenses, we also want to usually link them with sales. Now we look at the admin expenses in the first year, 2019, they are 800,000 and the sales are at 7 million. So what is the rate? This gives us 11%. And if we look at the next year, this is 2019. If we look at the next year, which is 2020, our admin expenses are 850,000 and our sales are 7.5 million, which gives us 10.6%, which gives us 11%. Now the next, this is 2020. In the next year, our admin expenses are 900,000 and our sales are 8.5 million, and this gives us 10.6%. And finally, in 2022, we have our admin expenses at 920,000 and we have our sales at 9 million, and this gives us 12%. So what then will this help us? You can see it was 11%, 10.6%, then we have 12%. So here we need to ask about the slight efficiency gains. So ask why slight efficiency gains, and discuss with the management so that you can investigate what the cause of that efficiency improvement is. Lastly, we can look at another ratio that you can look at, which is sales to customer receipts. How much have we received from customers versus what we have sold? Now, in the first year, which is 2019, sales to customer receipts, now we made sales of 7 million and we received from customers 6.9 million, which translates to 98.6% collection. In the year 2020, we have made sales of 7.5 million. So this is 2019. In 2020, 7.5 million. And our collections are 7.4 million. 7.4 million. And this translates to 99% collection. In the year 20, this is the year 2020. In the year 2021, our sales are 8.5 million. And our collection from such sales are 8.4 million, as can be seen here, receipts from the customers. That means that we have made a collection of again around 99% in 2021. And in 2022, our sales amount to 9 million. And our collections from the receipts from customers are 9.4 million. This translates to 104% collection. Now, the first one that you need to ask very fast is the 104. Why would we collect 104% of the sales we made? Because it seems unrealistic. Again, you need to understand why they are collecting 99, 98.6%, 99%, 99%, and 104%. This means they are almost collecting everything that they sell. They have no bad debts and they have no delays. So we need to understand and discuss with the management why these collections are very efficient. And also, we need to obtain another issue about the timing of receipts, which maybe is the next point we're going to discuss about, and compare the timing of receipts with the sales versus customer receipts ratios, and check if they are in tandem and reasonable. So now the next point after ratios is the point on the issue of timing of receipts. Timing of receipts. Now we need to look at how the receipts are being received, and also and payment to suppliers. Now remember, we have the financials for 2019. Now these financials that we have for 2019 can help us to be able to obtain such ratios, for example, like the receivables days. We can obtain the receivables days, and we can also obtain the payables days from the financial statements that have been audited. And once we have computed them, we also need to investigate and also match this with what we have in our sales of our customer receipts. Now the next point we need to, or the next procedure we need to conduct in this prospective financial information is to deal with depreciation expense. Now we need to look at the depreciation charge or depreciation expense. Now one thing is depreciation expense is not a cash flow. Therefore, we don't expect the depreciation expense to be included in the cash flow forecast. So one question we will ask ourselves is, could there be any other errors that have been committed, or could there be any other inclusions that have been made in the cash flow that should not be included? Because basically, a depreciation is just a charge on the usage of property, plant, and equipment, and does not represent a cash inflow or cash outflow. So it should not be included in the financial forecast. The next point we need to look at is on the issue to deal with what is the capital expenditure for. If you can look at it here, we have a capital expenditure of 200,000. So we need to ask ourselves, what is the capital expenditure for? And in any case, this question read that these people have expansion plans. On the first very line of the question is that ABC is applying for a bank loan to support its expansion plans. Now, if it's planning for expansion plans, we wouldn't have expected to see only year 2020 having a 200,000 capital expenditure budget, but would have expected the great chunk of this loan to go into the capital budget. So you need to ask if still they are using the loan for financing the capital budget, or they are financing it for operational matters. And you need to also ask yourself whether there are no other capital expenditure in the other years, and why only 2020. Is it in 2020 or it's in another year but they have included in 2020? The next point you need to look at in the discussion about procedures on PFI or prospective financial information is the issue to deal with the taxation. So you need to ask yourself, is taxation. So you need to ask yourself whether the taxation is appropriate. Is it accurately computed? Now, the first point to start with is to go to the financial statement for 2019 and obtain the amount that was included in the financial statements. And for the other years, you have to recompute the cash flow or the tax amount and check if the rate that has been used is correct. For example, in Kenya, the taxation rate is 30%. So you need to recompute. And also you need to look at other issues that may be of attention to you when you are calling out the prospective financial information examination. Remember, prospective financial information is based on future events which may occur or may not occur. And it's the practitioner's responsibility to ensure that all information that pertains to the prospective financial information, be it the assumptions that have been used or the prospective information that has been used also, whether it has been computed properly, so that the practitioner now can be able to give a report on whether the prospective financial information is reasonable for the circumstances that it has been prepared for. The practitioner must also understand what the use for this prospective financial information is. Is it for internal use or external use? And in their report, they must give disclaimers as to the usage of that report, because it must not be used for any other purpose. That marks the end of our lesson today. Thank you.